The traditional way to invest was that you would save some money and give it to an investment manager. They would be managing many other people's investments as well in a mutual fund, and they would actively invest your money by buying and selling. Now, these managers were thought to be experts in this field, hence they would provide a high return, but also high fees as well. Then came along the index fund in 1976. Now this had much lower fees and a passive nature, and 15 years after this we saw the first ever ETF, an exchange traded fund, very similar to an index fund but with some key differences. So in this video we're going to share exactly what index funds are, what mutual funds are, what ETFs are, and how to choose between them. We'll also be looking at how you can invest in index funds and ETFs, and we'll be giving some examples as well. On top of all that, I'm also going to share with you how great it would be if you could smash that like button. It would be great, and let's dive right in. Hey, what's up people? Welcome back to our channel, Ralph Finance UK. Now, a mutual fund is simply just a way for a bunch of people to pool their money together and give it to an investment manager who will actively invest your money by buying and selling. And so the real purpose of a mutual fund is simply just to give investors access to these portfolios of equities, bonds, and other securities. Now, mutual funds have been around since the 1800s, and people were investing in these actively managed mutual funds firstly for convenience, because by investing in a mutual fund, you get to own a bunch of different stocks all in one. You don't have to individually buy each stock, and so it does save you a lot of time. And secondly, for diversification. Index funds can typically consist of hundreds of different stocks, and so they are pretty diverse. Each stock only makes up a small portion of the overall index, and so if one completely crashes, your investment will still be okay. However, one of the downsides of these actively managed mutual funds is that because they use these professional fund managers, they tend to charge a lot of fees, typically around 2 to 3%, and this can cause a substantial reduction in your overall return in the long term. And as well as these management fees, some fund managers even take a percentage of the profits. As an example, consider a monthly fee of £30. Now, you may not think this is a large amount, but if you consider you invested this £30 instead every month for the next 40 years at a monthly return of 10%, then this equates to £190,000 in 40 years. The total investment you would have put down would have been just £14,400, and yet due to the power of compound interest, you would have £190,000. So we can see that just a £30 monthly fee does actually result in a substantial reduction in your overall return in the long term. And this example also shows why investing for the long term is so important, but that is a topic for another video. Now, on top of the high fees that are associated with these actively managed mutual funds, there was actually some research done by Standard & Poor's which found that 75% of the time, the S&P 500, which is the top 500 companies in the US, they actually outperformed these actively managed mutual funds. This essentially meant that the vast majority of these actively managed mutual funds often underperformed the markets, and so they were not worth the high fees. And the reason for this is many investors, including these portfolio managers, they tend to trade emotionally, and they panic when the market drops or they try to time the market. And so in 1976, Jack Bogle, the founder of Vanguard, invented a whole new category of mutual funds which were passively managed rather than actively managed, and these are called index funds. An index is simply just a measurement of something. So for example, the housing market index will just measure or track the house prices. A school performance index will just measure or track how good a school is. In finance, indexes were created as a tool to quickly measure the stock market performance, and so rather than having to look up thousands of different stocks individually, you can just look up an index. And a very popular index in finance here in the UK is the FTSE 100. This simply just measures how good the top 100 companies in the UK are doing. And other popular indexes in the UK include the FTSE 250, the FTSE 350, and the FTSE All Shares, and so on. So Bogle created the first ever index fund in 1976, the Vanguard S&P 500 index, which, as the name suggests, tracks the S&P 500. This means the fund simply buys whatever stocks are in the S&P 500. The annual fee is just 0.14%, and by investing in this fund, you have access to some of the biggest companies over in America, such as Amazon, Apple, Microsoft, and Google. And the reason I keep referring to the S&P 500 is because it does have companies like Apple in there, and Apple's market cap is bigger than the entire FTSE 100. And so we shouldn't just be considering investments in the UK. It is definitely a good idea to diversify outside the UK as well. So Bogle created the index fund as a way for retail investors to compete with the pros. Now, rather than having a group of different stocks in a mutual fund with the hope of beating the market, Bogle's index fund allowed investors to approximate the market's performance, but at a much lower cost than the high-fee, actively managed mutual funds. Now, the main reason for these lower fees was because index funds are passively managed. It essentially eliminates the need for an expensive investment manager to make the buying and selling decisions, and so the management fees are much lower, typically around 0.03 to 0.04% compared to 2 to 3% for an actively managed mutual fund. And as we've already seen, these small fees can add up considerably over time. And overall, tracking an index is very simple. I mean, they're very simple to put together, they're very simple to manage, there isn't much overhead cost, and all of those savings get passed straight onto you as the investor. It has actually been found that index fund investing has outperformed 99% of active investors over a 20-year period, and so it is viewed as a much better alternative to the traditional mutual funds. Warren Buffett, one of the world's greatest investors, actually challenged the hedge fund industry, which in his view charged an excessive amount of fees that couldn't be justified by their performance. So Buffett took a $1 million wager, so that's around £740,000, that investing in an index fund would make you richer than if you entrusted it with a hedge fund manager. And so Protégé Partners took him up on his bet. And Buffett won, big time. By the end of the bet, which actually went on for 10 years, Buffett's chosen index, the S&P 500, they averaged 7.1% annually, whereas Protégé Partners averaged only 2.2% annually. There is a reason we pay attention to Warren Buffett, and in all fairness, it was pretty silly to bet against him, but fair plays to the firm because they were the only ones who took up Buffett on his challenge. So generally, you can invest in 4 different types of index funds. You have index funds based on company size, so you can have index funds of small companies, mid-tier companies, or large companies. Secondly, you can have index funds based on location, like the UK or the emerging markets or foreign markets. And thirdly, you can have index funds which track a specific business or sector like tech, retail, or real estate. And you can also have index funds that track currencies and bonds. So no matter who you are or what you want to invest in, it's almost guaranteed that there is some type of index fund that you can invest in. Now, a great advantage of index funds is that you don't need to pick individual stocks. So if you choose the FTSE 100 index, then all the stocks are already chosen for you, which means you do not have to go through the financial statements for each and every company. And it's also one of the easiest ways to diversify your portfolio. Again, if we take the FTSE 100 index, then you've diversified amongst 100 of the top companies within different sectors in the UK economy. By buying index funds though, you will never beat the market. So if the FTSE 100 returns 10%, then any index fund which tracks the FTSE 100 will also return 10% or slightly less due to the fees. But overall, due to the lower fees and the better performance of index funds, they became much more popular when compared to the traditional actively managed mutual funds. Now, 15 years after the first index fund was introduced, we saw the first ever ETF, also known as an exchange traded fund. Now, these are very similar to index funds, but for one major difference. With index funds, you can only buy and sell shares once a day. And this was Bogle's way to encourage people not to view index funds as a short-term investment. However, with ETFs, you can buy and sell your shares whenever the stock market is open, so it offers 24/7 tradability. Now, when Bogle created the index fund, he intended for it to be a long-term investment only. He did not want it to become a short-term trading tool, and so this is one of the reasons Bogle never liked ETFs, so much so that he actually rejected the chance to list America's first ETF. He was dismayed that these long-term index funds had now been kind of morphed into these short-term ETFs, because the fact that you can trade an ETF just like a stock, That means you can see it going up and down on the stock market, and this usually encourages impulsive buying and selling, and it can reduce your long-term returns. Bogle has actually said that during the past decade, the principles of the traditional mutual fund have been challenged by a sort of wolf in sheep's clothing, the exchange-traded fund. He then goes on to say, but let me be clear, there is nothing wrong with investing in those indexed ETFs that track the broad stock market, just so long as you don't trade them. And so this short-term trading that an ETF encourages is exactly what Bogle did not want, and he insists that you should only use ETFs as long-term investments. Again, like index funds, there are ETFs for pretty much every single market out there. Bonds, real estate, through REITs, and a lot of the time you will hear the terms ETFs and index funds used interchangeably, but they're not the same thing. Index funds trade at maximum once a day. ETFs trade whenever the market is open. As an example, if you wanted to invest in the FTSE 100, you can either go with a FTSE 100 index fund or you can go with an ETF. Now, most people who buy mutual funds intend to hold them for the long term and sell when they are close to retirement, so this does somewhat mean you just don't need the 24/7 tradability of an ETF. Now, another major difference between index funds and ETFs is that index funds offer automatic reinvestments, and this makes it really easy for you to save and invest without really doing much. Index funds allow you to set up a recurring monthly deposit from your checking account, and they'll automatically buy more shares for you every single month. And the best part of this is that there's no additional charge for doing this. On the other hand, ETFs do not offer this feature, and so if you wanted to contribute more to your investments every single month, you would have to manually buy more shares of the ETF every month. Now, to actually invest into index funds, you first have to decide what index you want to track, and then you have to decide which index fund you want to choose. And there's many different index funds which all track the same index. Now, we will be looking at some examples of index funds and ETFs, but before we do, I just want to say I am not a financial advisor. I'm not telling you what to invest in, I'm just giving you these as examples. So always make sure to do your own due diligence when making any investments. So first we look at the index funds that track the S&P 500. Again, like I said before, just a single company, Apple, is bigger than the entire top 100 companies in the UK. So we should be looking beyond the UK as well. So if you believe in the US economy as a whole, then you would want to invest in an index fund that tracks the 500 largest companies in America. Companies like Apple, Amazon, Google, and Microsoft. An example is VFIX. This has an expense ratio of just 0.04%. It does have a minimum $3,000 investment, so that's around £2,200. You can also invest into the S&P 500 via an ETF from Vanguard, more specifically VOO. This doesn't have any minimum investment and it has a lower expense ratio of 0.03%, but it doesn't allow for automatic investment as it's an ETF and not an index fund. And secondly, if you want to get broad exposure to the international stock market index, you can invest in FZILX. This has more than 2,000 different stocks and it allows you to gain exposure to the foreign and emerging markets, and these may perform well in the next few years. This fund has companies like Alibaba, Tencent, Nestle, and Toyota in there. This actually has a 0% expense ratio, and so it is free to hold. Overall, investing in index funds is one of the easiest and most effective ways for an investor to build wealth. Investing does not need to be complicated, and so by simply matching the performance of the financial markets over time, index funds can really cause your investments to grow over the long term. And one of the advantages of buying index funds is that you don't need to be an expert in the stock market to do it. So if you found value out of this video, which I really hope you did, then please do give us a thumbs up, and why not subscribe so you don't miss our next financial education video. I'll see you on the next one. Take care.